Do you want to diversify your portfolio? Are you looking for an investment that could offer you inflation beating returns? It's time to invest in mutual funds. Hello everyone, I am Prarthana from ClearTax. The Sensex has scaled the 50,000 mark for the first time. It has rallied 91% from the lows of March 2020 following the global pandemic. However, should you stay invested, redeem, or invest more money in mutual funds? To find out the answer, please keep on watching.
The first question that needs to be asked is, why did the Sensex rise to 50,000? Well, the COVID-19 pandemic led to economic slowdown as the government imposed a lockdown to curb the disease's spread. You may have noticed that central banks across the world pumping vast amount of money into the financial system to push down interest rates. The RBI cut interest rates last year to persuade businesses to borrow and invest in creating jobs, as it encourages you to spend more money as loans become cheaper. The production of the COVID-19 vaccine further boosted the equity market. Foreign institutional investors continued to put money in the Indian stock market, and the Sensex scaled the 50,000 mark. Now comes the most important questions. What to do with your mutual funds? Number 1. Invest in mutual funds for the long term. You may consider staying invested in equity funds for 5 or more years to attain your long-term financial goals. You could redeem equity funds only if they have underperformed the benchmark index such as the BSE Sensex or the Nifty over some time. You may consider keeping a check on your emotions while investing in equity funds. You would find many investors redeeming equity funds in panic during the lockdown. However, the Sensex has risen from the low of 25,638.90 on March 24, 2020 to the cross 50,000 mark in under 1 year. It would help you to focus on your long-term financial goals irrespective of the stock market's movement. Number 2. Review your mutual fund portfolio. You may consider diversifying your mutual fund portfolio with debt funds to protect it from the stock market's volatility. You could spread your investment across asset classes depending on your age, financial goals, and risk tolerance. You may also consider reviewing your mutual fund portfolio at least once every 6 months to check if it meets your financial goals and risk profile. You could book profits in mutual funds if you have attained your financial goals. However, it would help if you focused on the right asset allocation, which is vital to attain your investment objectives. Number 3. Continue your SIPs in equity funds. You may invest in equity funds through the systematic investment plan or the SIP instead of a lump sum amount. It is a way of regularly investing a fixed amount in a mutual fund scheme of your choice. It is tough to time the market during rare events such as the coronavirus pandemic. You don't need to time the stock market if you invest in equity funds through the SIP, as investing in mutual funds through the SIP helps you accumulate wealth over the long term. You may consider continuing your SIP even when the Sensex is at 50,000 points. It eliminates the need for you to time the market, and losses due to market fluctuations are evened out over some time. You could invest in the right equity mutual fund scheme through the SIP and continue your investment even if the Sensex rises.
So, what did you decide to do with your mutual funds? Let us know in the comment section below. Also, don't forget to give this video a big thumbs up and of course subscribe to ClearTax's YouTube channel for regular updates and videos on finance. Stay tuned and take care.